So as Jamie Dimon said last week, where there's one cockroach, there are probably more cockroaches. So I see a story yesterday out of KBRA, that's Kroll Bond Rating Agency. Their website, they issued a news release a couple days ago that they have issued a ratings watch downgrade on another subprime auto lender by the name of First Help Financial, FHF. And Kroll, by the way, is kind of a competitor to Moody's, if you will. They're a much smaller share of the market. They haven't been around nearly as long as Moody's has, but they are a nationally recognized statistical rating organization approved by the SEC. And according to Chat, they're often used by mid-market banks, REITs, and structural credit shops. So headquartered in Needham, Massachusetts, First Help Financial is a subprime auto finance company. By the way, this is from the actual KBRA news release, October 24th. But the news, I think, came out yesterday. But again, it wasn't broadly covered by the mainstream media. Okay, so they're a subprime auto finance company that was founded in 2006 and currently offers loans in 29 states. They're an independent auto lender. And what they do is they purchase receivables from franchise and independent dealers. I pulled the top independent dealers in the United States: CarMax, Carvana, and AutoNation. I'm sure you guys have heard of those. Okay, so they provide funding to those independent dealers based upon the dealers pledging their receivables as collateral. Doesn't this sound familiar? Go back to my shows from last week, right? NDFIs, non-depository financial institution loans. I'll explain to you in a second. Please stick around how this is exactly what we saw a few weeks ago with Tricolor and to some extent with First Brands as well, which have both ended up in bankruptcy. So give me your thoughts and comments. Is this where it's heading here pretty quickly with First Help Financial? We will see, but I'll share the numbers with you in a second, and it's pretty staggering, okay? Stuff starting to come to the surface, hence the name of the thumbnail, or the title for the thumbnail for today's show. Before I jump in further, as I always humbly ask, if you're not subscribed to this channel, I would really appreciate you guys hitting the subscribe button so we can keep growing the community. And thank you to all those who have come over to the channel, in the last couple of weeks. I appreciate you. So the company is privately held, okay, as of June 30th, 2025. By the way, FHF, privately held. As of June 30th of this year, they had total assets, it says, of $1.2 billion and equity of $103 million. As of September 26, 2025, the company had drawn $261.10 million of its $700 million in funding commitments from four warehouse lines. The warehouse lines, as discussed in last week's shows, for these NDFI transactions are provided by the bigger banks. Many of them, the too big to fail banks, the JP Morgans, etc. Additionally, the company has sold over $320.16 million of whole loans to community banks. So the community banks, by the way, we don't know which community banks, how much the loans are, but they're being held in these books or on these books of these community banks until they surface as bad debt, okay? So the $700 million of credit facilities, warehouse lines of credit that were extended by the larger banks, again, that's also not public information. I tried to search what were the larger banks that lent or established these credit lines for First Help Financial. It's not public information. Now, you could back into it by doing a UCC1 search, I believe, but I haven't taken that step, okay? But I'll bet you, and I'll share with you again, going back to last week's video when Moody's did a breakdown, and I shared it, of the consumer NDFI transactions that have been put together, consumer debt NDFI transactions for subprime auto and other consumer deals and I'll share the breakdown with you again in a second. Okay, it says in 2024, 96% of originations, okay, for First Help Financial were sourced through franchise dealers, and the remaining 4% through independent dealers. The company's target consumer base is typically unable to obtain financing from traditional lending sources, such as credit unions, banks, and captive auto finance companies. FHF's obligors may have, and here we go, limited or no credit history, and may be immigrants with an unverified immigration status. Okay, so again, they're lending indirectly, right, through the independent dealers or through the franchise dealers, money's off their lines of credit, okay? And the collateral, right, is the guarantees or the vehicles that are taken out by people that may have no credit history, don't have or have shown terrible ability to repay their obligations, or may not even be legally, in the United States. So back to yesterday's video. I'd love to get your thoughts on this. Is this their fault? Is this the consumer's fault? They can't get a loan somewhere else. They're going to go and get a loan from whoever will extend them credit, right? And that's a weak link in the system. Those start getting compounded through a company like First Help Financial that's holding the receivables as collateral for these loans to the independent dealers and the franchise dealers, okay? So that's what's happened. That's the contagion that's in the system. And ultimately, when these dominoes fall, it flows uphill to the larger banks that advance the warehouse lines of credit. Now I'd love to know on what underwriting standards the big banks thought it was prudent to establish, or I should say extend, 4 different lines of credit to First Help Financial totaling $700 million, right? When their total assets were $1.2 billion. All right, you guys give me your thoughts on that. I'm definitely not a credit analyst or expert in that. In says KBRA will continue to monitor the performance of the 4 transactions with watch placements and expects to resolve or update the watch placements within 90 days. Okay, so I guess the questions, and this is definitely Ndfi type transaction, okay, with First Help Financial being the intermediary, okay, the non-financial or non-deposit financial institution that receives money from the JP Morgans and from the Bank of Americas, Wells Fargo, Citigroups, etc., okay, because those big banks are not going to enter directly into those risky transactions with the independent dealers or with the franchise dealers because of the risk and because of regulations put on them right after the 2008 financial crisis. Okay, so they use these intermediaries, and now we're seeing another intermediary, potentially another cockroach here, that is red flags are being raised. Let me explain to you how it was similar to a Tricolor and to First Brands that both failed a few weeks ago and sent some mini shockwaves through the market. Before I jump into that, I did share this with you last week, the Moody's article about the big banks that advance these warehouse lines of credit. They're into this for $128.2 billion. That includes loans to facilitate asset-backed securitizations of auto, credit card, and student loans. JP Morgan, I shared this with you guys last week. This was the consumer, okay, credit breakdown, right? So JP Morgan is 26 billion, B of A almost 20 billion, Wells Fargo almost 20 billion, Citigroup 31 billion, and US Bank almost 10 billion. Okay, well, we know of the $26 billion, the JP Morgan just last week, the week before, wrote off $170 million as it related to their, lending of money. It was, I believe, the First Brands transaction that JP Morgan was involved in. They've already written down $170 million. Okay, so are they one of the banks that has also advanced some of the lines of credit to First Help Financial? Any portion of the $700 million is now floating out there? We'll have to wait and see, all right? We can't get it. It's not public information, of course. So here's the similarity between First Help Financial, and I love these names, right? First Help Financial, First Brands. So a Tricolor subprime auto lender, okay, dealer filed for Chapter 7 on September 10th of this year. It's alleged that they engaged in double pledging of the same collateral, auto loan portfolios to multiple lenders or warehouse credit lines, okay? And in that case, 70% of their loan originations were made to very high-risk borrowers without credit scores in one description and dubious collateral cash flow controls. So Tricolor, from what I can tell, same kind of a setup as we're seeing here with First Help Financial. All right, so where do you think this is going to go? Is it going to have a different ending? In 90 days, is First Help Financial going to all of a sudden clean up its books and show that that all of the underlying collateral, the receivables from these subprime borrowers, is all of a sudden strong? I don't think so. Second one we saw a few weeks ago was First Brands. They filed for bankruptcy in September of 2025, $10 billion in liabilities, and they used large amounts of off-balance sheet financing via factoring of receivables. Same thing, I don't know about the factoring, but the receivables, right, are being pledged in the First Help Financial transaction, all right, to First Help to get money from First Help to these dealers, okay? So are we going to, I have a couple questions here that they're kind of rhetorical, but love to get your thoughts, and I'll wrap it up. Will it turn out that, it's rhetorical, I'm not saying they did, I don't have any evidence of this, but they're on a watch list for a reason. Will it turn out that First Help Financial is found to have pledged the same collateral, right? The receivables from the dealers to multiple larger banks to get lines of credit. Again, they have $700 million over 4 lines of credit from one or more larger institutions. Okay, so that seems to me to be a monstrous number, given although they say they're having 30 to 40% year-over-year growth, right? And that's because there are more subprime borrowers out there, more broke consumers that can't get regular credit, so they're going to these help companies to get a lifeline. Okay, so that's question number one. Will we see that? Okay, and how much more will the big banks have to write off regarding First Help Financial? Right, we'll wait and see. And then the second thing is again not published, but how much did the larger banks contribute to this subprime auto lender? So I don't want to go too long today. I'll wrap it up with this. Are we seeing let's say front running of some of these mid-sized banks to consolidation? I will tell you this. We shared, you guys probably all saw in the media a couple weeks ago, how Zion's Bank, through their subsidiary Cal Bank and Trust, that they got in some hot water with that Cantor group. Okay, that had to write down $50 million against their earnings last quarter because of these, messed up Ndfi loans, right? And again, they were the intermediary. Well, they were the bank that lent to the intermediary, in that case, Cantor. The collateral was not there. Not subprime auto, but again, just about 4 or 5 months ago, Zion's Bank, okay, and Cal Bank and Trust acquired 4 branches of First Bank right here in my local community in Southern California, okay? And it was $730 million of deposits and $420 million of loans that Cal Bank and Trust acquired from its purchase or consolidation with 4 of these First Bank branches. And now these branches have consolidated, and they've all been named, or they're now all Cal Bank and Trust branches. And Cal Bank and Trust is in hot water on some loan stuff. Is Cantor Group the only, let's say, underwriting oversight or mishap that they have in their books? We'll have to wait and see. Yesterday, I got an email from First Foundation Bank, another local bank here. I don't know if they're all over California or not, but they're now, and I have an account with them on a separate business. And it says, we're excited to announce that First Foundation is merging with First Sun Capital Bank Corp. The strategic combination creates a well-capitalized top quartile regional bank with approximately $17 billion in assets that operates in many of the fastest growing and highly valued markets across the country. Okay, I don't know anything about First Sun Capital Bancorp. Leave your thoughts and comments. First Foundation, they cater to some pretty high-end clientele here in our more affluent communities, okay, in the desert area. So now they are merging with First Sun Capital, all right? And that was an email I got from them because I'm a client. I also see an article yesterday or a news flash that Huntington Bank Shares has incorporated to acquire Cadence Bank, and that was from yesterday. All right, it says Columbus, Ohio, and Houston and Toledo, Mississippi, October 27th. Huntington Bank Shares Incorporated today announced it has entered into a definitive agreement to acquire Cadence Bank, a $53 billion regional bank headquartered in Houston, Texas, and Toledo, Mississippi. So are some of these regional banks, do they know what's on their books? Do they know how much rot, how much contagion there is? And so they're kind of scurrying to, let's say, to kind of front run what is coming. Maybe, again, I'm reading too much into it, but that's just three big news stories of consolidation as we're seeing all this contagion kind of come to the surface with the Ndfis and basically illusory collateral. All right, I'll leave it there today. Sorry I went a little bit long. If you guys enjoy the content, I would appreciate you hitting the like button for me. If you're not subscribed to the channel, please hit the subscribe button for me. Your thoughts and comments are always welcome and appreciated. I do my best to read and respond to those, time permitting. And with that being said, I will talk to all of you soon. Bye.